There's three main themes that defined investing in 2022. It was a year of big declines, high inflation, and increasing interest rates. This makes for a challenging investing environment, especially with increasing concerns of a recession around the corner. It raises a lot of questions about what should we be doing in 2023 to ensure a successful year of investing. So let's address these three concerns, especially when it comes to investing during a recession. Market declines. In 2022, we saw the stock market go down 20%. The Nasdaq was down 30%, and some stocks, such as Facebook and Netflix, were down up to 50%. At times like that, it can be very scary to think about putting money into the market, especially when prices are going down. You're just like, I don't want to do that. But the key to success, especially over the long run, is to be a net buyer of assets, to be a net buyer of stocks. You want to be buying as much as you can whenever you can. And when there's a lot of fear in the market, that's generally the best time to be buying, especially because you can get the best prices. And the worst thing, the one thing you don't want to do is sell during that time. And besides, why wouldn't you want to buy stocks when they're on sale? In fact, the stock market is the only place people run out of the store during a sale. So if you do the opposite of that and just keep buying, you'll be way ahead of everyone else. And during this time when prices are going down, you want to take advantage of an idea called dollar cost averaging. The concept is that when prices are declining, you just keep buying. So you're buying on the way down, you're buying every few weeks, every paycheck, and you just buy more and more. The benefit is as prices go down, you're able to buy more shares. So for example, let's say you've got $100 and one share is $100, you buy one share. But now let's say over the year the price goes down to $50, but you're still investing that same $100. Now that $100 can buy you 2 shares. And that just means you have a bigger percentage of the company. And over the long run, when you look back, because you've kept on buying when prices were up and prices were down, your average price point will actually be a lot lower, especially compared to everyone else who often are just going to be buying on the way up. One of my favorite books goes into the idea of just keep buying into a lot more detail, regardless of what's going on in the marketplace. You can find a video of where I talk about it more here. Okay, now high inflation. There's a lot of concern that inflation is going through the roof and it's impacting a lot of consumers because it's decreasing their buying power. Inflation not only impacts consumers, but it impacts businesses as well. It causes their costs to go up, which can make them less profitable. And that's important because as an investor, if a company is less profitable, there's a higher chance that the price of that stock is going to go down. So that's why we care about this. According to Warren Buffett, one of the best hedges against inflation is to improve your own earning power, and the best passive investment is a good business. So what does that look like? That could look like a few things. For example, you could look for a new job. People who switch employers every 2 to 3 years, on average, outperform those who stay with the same company for a longer period of time. Especially right now where wages are at an all-time high, there's a lot of demand for jobs, a lot of job openings. This might be a great time to freshen up that resume and maybe see what's out there. Another option is to start a side hustle. This is something that you could do either after work or on the weekends to make some extra income that you could then use to, hopefully you already have enough to pay for your lifestyle, but you can use this income to save more or invest more. I'll do another video later on some of the best side hustles that I think you should be starting in 2023. And if you're looking to invest, according to Warren Buffett, you want to be looking at companies that have huge moats and a big competitive advantage. One of my other favorite investments is cash flowing real estate. It's often deemed one of the best hedges against inflation because you're able to pass on a lot of your costs to your tenants, so you're still able to make that positive cash flow. Back in 1982, Warren Buffett released his annual shareholder letter. And in his letter, he goes through what he looks for in businesses during times of high inflation like we're in now. So the first one is he's looking for those that can increase prices rather easily, even when demand is flat, without fear of significant loss of market share. So think about a company like Coke. You're still going to buy Coke even if prices go up a little bit because they're that leader in the marketplace. You're not going to stop buying Coke because a competitor or store brand is 20 cents cheaper. You're still going to buy that Coke. I mean, I would. And then the second is an ability to accommodate large dollar volume increases in business with only minor additional investment of capital. So what he's addressing there is really scalability. Think of a business like Microsoft or Facebook, where they produce software. versus a company like Tesla that produces cars. Now, if Tesla wanted to go out there and sell more cars and they didn't have enough, they'd have to build a brand new factory, which takes a lot of money to do and a long time to get up and running. Versus Microsoft or Facebook, if they want to sell more ads or sell more software, it's probably as easy as copying and pasting that software onto another hard drive or something, right? And then the last concern is rising interest rates. As we've seen over the past year, whenever the Fed has announced that they're increasing rates, if it's been a higher than expected rate, stocks have gone down. During an increasing rate environment, a lot of the investment firms will go out and buy bonds instead of stocks. So they'll start selling their stocks and go buy bonds. And the reason they do that is because they're able to get better return with less risk. So let's take a look at 2020. When the COVID crash originally happened and the Fed basically cut their rates down to zero, a lot of these firms were like, okay, I'm not making any more money with bonds, so I'm going to get rid of all of those and go buy stocks instead. And that actually caused stocks to go up a lot over the past 2 years. And now the opposite is happening, where the Fed is increasing rates. So now these firms are like, okay, I'm going to get out of my stocks and go buy bonds instead, because I can get a bond and make 4, 5, or 6% return on it pretty much risk-free. Why would I risk my money, risk buying like a Facebook or an Apple where I might only make a little bit more, but I risk a lot more to get that extra bit? So they're happy just buying bonds. But I really think that that's very short-sighted of them, because in the long run, when we think about stocks over decades, they have generally outperformed bonds. Now, bonds may have outperformed in some periods like we're seeing right now, but in the long run, stocks outperform. And once interest rates stabilize, which I think is going to be happening very soon, I think we're going to see bond rates start to either stabilize or decline. And so what that means for these firms is they're probably going to stop buying bonds and go buy stocks at that time. And when that happens, we're likely going to see a big rally in the stock market. So all those small shares that you're buying over that long period of time, dollar cost averaging, they're going to go up a lot. So it's going to be worth it. So stay ahead of everyone else by thinking in decades, not years. Focus on buying good quality businesses and find ways to increase your income. I hope you found this video helpful in navigating these uncertain times. Be sure to check out some of my other videos and be sure to subscribe so you don't miss next week's video. I'll see you then.